Hey there guys, how's it going? Chillingworth here. It is Friday the 6th of September. Welcome to this video. I wanted to do, a little while ago I did a video on BAE systems where we took a look at the financial statements and we crunched the numbers and we had a look to see whether or not they're a company worth investing in and how they fared essentially from a financial point of view. And when I look at these companies and I look at the financial numbers, I'm really looking for where we're kind of envisaging where this company is going to go in the next 5-10 years. This is long-term trading, you know. I don't use fundamental data. I don't use any of this financial data as part of my 1 hour trading, because I don't believe these numbers really have anything to do with what's going to happen to a share price over the next day or so. I don't think there's any direct correlation between that. You know, if a company's doing really well in terms of how they're running their business and how they are growing as a business, I don't think we're necessarily going to see much from that over the course of the next 4 1 hour bars, right? However, from a 3 to say 10-year point of view and perspective, then these numbers really do help us to identify companies that are going to grow and do well over that period of time. And so therefore this is a much longer term approach. These are companies that personally I'm buying shares in and I'm holding until, you know, 10-20 years away probably, that are delivering me a dividend that I will be reinvesting. And basically these are shares that I plan to own that will provide me with passive income as well as capital gains hopefully over that period of time. And I'm looking at finding companies that I can invest in the long term that will also help me on my daily spread betting approach, which is a lot more getting in and out. I'm holding positions for maybe a year and then I'm getting out of that trade. So this works from both of those approaches, but not so much with the intraday stuff, which kind of makes sense. But I wanted to look at two companies today and compare them. I want to look at home and construction industry or the sector, and two companies that I want to look at today and put side by side are two companies that I've been doing some analysis on and comparing the two, and they are Barratt Developments and Persimmon. Now both of these companies are in the home construction industry. They are, you know, rivals I suppose to a certain extent. They are both FTSE 100 companies, and there's one that I have already invested in, and this isn't a bias or anything like that at all. You know, I don't, whether you invest in it or not has no skin off my nose. But one of these companies I'm invested in already because of this data. The other company I'm not going to be invested in, and I want to show you the difference between the two, and then explain, you know, the decision making basically. So on the left-hand side, we've got the data from Persimmon. So all I've essentially done here is I've extracted the public access data for shareholders and put it into a spreadsheet that focuses more around the information I'm interested in. So this isn't a verbatim like-for-like extraction of data put into a spreadsheet. I've only taken the information that I'm going to use to deduce whether or not they're a business that I'm interested in in investing in. So on the left we've got Persimmon, on the right we've got Barratt Developments. Epic codes are PSN for Persimmon and BDEV for Barratt Developments. And we're looking over a 6-year time period here. I do actually go further back on both of these, but I'm only really interested for this comparison at the moment for this video, just looking back at the last 6 years worth of data. So first of all, what we generally would look at is the revenue. What money is coming into the business based on what they do. So on the left, you can see Persimmon's not quite as big a company as Barratt Developments, because as of the last report that came out, they were turning over, or they had a revenue of 3.7 billion. That is, this is in millions, so 3,737 million. Otherwise known as 3.7 billion. And over on the right hand side, Barratt are the bigger company at 4.8 billion. Okay, so they've got more money coming in. However, as you can see, cost of sales then comes into play. So this is the cost of the actual service that or product that they provide. So we're not talking about rents and staff costs here. We're simply talking about the cost of selling what they sell. So if it's home building, you're probably looking at the cost of the bricks, the cost of the materials required to build the homes that they build. Okay, It might be land costs and things like that. I have no idea, but that's essentially what this figure means. Now, as you can see, then then once you've deducted that cost of sales, you've got your gross profit, and then underneath is your margin. So the margin is essentially the slice of the cake that you get. So if you think of the revenue as the cake that they have, what slice do they get to keep? Basically, what slice of that are they getting? And as you can see here, despite Barrett being a bigger company in terms of the revenue that's coming into the company by 1.1 billion, quite a bit of money, the gross margin for Persimmon's higher, much higher. So 20% for Barrett. They're only getting a 20% slice of that big figure, whereas Persimmon are getting a 30% slice of that revenue, which means their business is more efficient. They may not be making as much money out there, but they're taking a bigger slice of what they are getting, which is great. And then when we look at expenses, this is the staff costs, the wages, the stuff like that, the bills, the office rents, all that kind of stuff. So that's the day-to-day running administration side of things, advertising, marketing, that sort of stuff. And Persimmon, they're running at 7.9% in comparison to double that, essentially, at 14.5% at Barrett. So Barrett are taking a smaller slice and they're paying higher expenses. Okay. Then we're looking down here. The next thing I'm interested in is the interest being paid on debt. So before, Barrett were actually quite heavily using debt to the point where the debt was probably far too high for the size of the business. They were borrowing a lot of money back to sort of 2010, 2011, 2013, and then they got it under control. They still have a certain level of interest being paid on debt. At the moment, as of last year's report, 45 million was deducted from their net earnings, their profits, because they had to pay that on interest on debt, and it's currently about 5.2% of their operating profit. Whereas over here on Persimmon, they're actually making money from finance, so they have no debt whatsoever, and we find that when we go down into the assets and liabilities, they actually aren't carrying any debt at all. So yeah, they're doing really well, Persimmon, and they're actually making money from presumably lending some money somewhere else and making some profit somehow. So they got the opposite of debt. They're actually lending by the looks of things. So they're doing pretty well. In comparison, I mean, Barrett aren't doing badly. They're the debt levels are well within what they can stomach. It's 5.2% of their operating profit. It's nothing. But Persimmon are doing better. Then we go down to, we could look at tax, but there's really not much point. Tax is the tax, I mean, obviously we expect these companies to be as tax efficient as possible. They're not going to be paying unnecessary amounts of tax. They'll only be paying what they need or have to pay by law. Tax dodging aside, but we're not going to go into that. So then we come down to the net earnings. And what I've essentially done here as well, and this is important, is a lot of these companies, when they publish their annual reports, they will make extra money from the sale of assets. So it could be the sale of intangible assets like rights or patents or something like that, or it could be property, plant, equipment. It could be selling an entire section of their business. And the problem is, for an accounting purposes, it absolutely has to go in their accounts, right? But if you are just looking at the raw numbers like most investors do, most investors are just using some sort of software or service that just shows them the raw numbers of how much money did they make and is there growth there. The problem is with that is that you're not going deep enough, because those numbers can be very misleading. And from a point of view of an investor, what you should be looking at is, where is this money coming from? Is it actually coming from the day-to-day running of their business, or is it coming from one-off sales of assets that are not going to be repeated? Because once you've sold those, you can't resell them again. And so you can sell big chunks of the business for $1 billion or £1 billion or whatever. You're not going to be able to sell that arm of that business again next year. So it's not recurring income. It's just a one-off extraneous income. The problem is it can make the figures look way better than what they actually are. And so part of this process for me is to go through those financial reports, through the financial statements and everything, and identify the extraneous, the one-off sales of assets rather than what's actually coming into the business, and I deduct that from the results. So these results you'll see here take all that into account. It removes anything that is not part of the day-to-day running of the business. That's very important. And so what you'll see here on the left-hand side is Persimmon are making a 23.6% net earnings in comparison to Barrett's 13.4%. Now, we aren't going that far back, but what you'll see is from 2008, 2009, obviously with the mortgage crisis and the subprime crisis that went on, these two companies took massive hits, as you would expect in the housing industry. Now, what happened, what I'm interested in, is that Persimmon recovered within about 2 years. They were well back into it. They were building homes again. They were making huge money, and they've been growing and growing consistently ever since. You look at the net earnings, and from 2013, you're looking at 11.9%, 14%, 17, 19, 21, 23. So every year they've been growing very, very nicely. And this is basically the money that's left as profit for the shareholders. Okay, so 247 million all the way up to 880 million profit for shareholders at the end of last year's annual report. Barrett took a lot longer to recover from that, to the point where they still only really achieved their recovery by 2015. So it took them many years before they started to really start making good money again. And in 2015, they made a 10.8%. Well, Persimmon were already making 11.9% by 2013, so they were well behind Barrett. And that doesn't necessarily tell you everything, but it's, again, another box to be ticked in favour of Persimmon, because, again, Persimmon seemed to be about 3 or 4 years of growth ahead of Barrett, despite the housing crisis happening to both companies at exactly the same time. So Persimmon are running themselves in a way that's allowed them to recover far quicker and grow at a much faster rate than Barrett. And when we look at the actual raw figures in terms of the actual profits made, Persimmon at the end of 2018 were making year on year 880 million profit for their shareholders, and Barrett are still only up to 650 million. Still great money. They're still a profitable business, don't get me wrong. We're just comparing the two. So I'm not necessarily saying that Barrett Developments are a terrible company. I'm just saying when you're comparing these two housing companies together, this information is all pointing towards Persimmon being the better bet in terms of which one's more likely to go up in share price, which one's likely to be the best company to invest in over the next 5 years, let's say. So Persimmon are looking like the better choice right now. Then we can go down into, and this is despite obviously Barrett making more money, right? So they've got more revenue coming in, but the cost of running their business, so that's expenses, that's the cost of sales, that's the interest being paid on debt, there's the taxes, all of that kind of stuff put into it. They're only taking 650 million compared to Persimmon, who are bringing in a lot less money by 1.1 billion in terms of revenue, yet they're running so much more efficiently as a business. They're taking a bigger slice of the profits. They're not losing money, so much money on expenses. They're cheaper to run their business. They're paying far less in terms of interest on debt because they don't have any debt. You know, all of this stuff makes them more efficient, and so they're taking 880 million of less money. So they're getting a much bigger slice. So that's really good, because that means that they're in a much better and stronger position in terms of a business. So let's say we go for a period coming up where we go through a bear market or something happens in the housing industry. The data would suggest Persimmon would be able to handle that better than Barrett Developments would be able to. That's just what the data is essentially showing. And we're just looking at the factual stuff here. We're not trying to make any predictions in that sense. We're just looking at fact. So then we can go down to assets. The assets and liabilities comparison is pretty similar, to be fair. What I'm looking at here is what current assets they have in relation to their current liabilities. What we're talking about is assets that can be turned into cash within the next year, and liabilities that are due within the next year. So these could be invoices that they've been sent for stuff but they haven't yet paid. That would be a liability, and that could be an invoice that's got to be paid within the next year. So they add all that up for accounting purposes and work out right. So Persimmon owe 1 billion in unpaid invoices that are due within the next year or so. not just invoices, but that will make up a large amount of it. And then looking over at Barrett, they're looking at 1.4 billion in the same period. Basically, that's got to be paid in the next year. And so that we can go through all the stuff. We can look at what debts are owed in the next year, and what debts need to be paid off. And you can see here Persimmon have none. Barrett have had some, but in the last year they've got it down to zero, so they've slowly paid it off. So that's good. So they're both sitting on no short-term debt right now, which is great. But what we will do is we will take a look at the current assets and compare that against the current liabilities, and we're looking at about the same. So we're looking at this current ratio essentially, which basically says that there are 3.8 times the amount of assets against liabilities. So that means that they're very well covered. You don't want to see more liabilities than assets, of course. And then we can go and Barrett are 3.7, so they're pretty much the same too. I'm just going to scroll this down. Let's have a look at long-term debt. So this is debt that they have that doesn't need to be paid back within the next year. It might be the next 10 years, let's say. Well, you can see here Persimmon, they don't borrow money. They never have. They've achieved everything they've achieved without needing to borrow anything. No short-term debt, no long-term debt, and they never have. Whereas Barrett certainly have had a history of debt. In fact, some of their debt was huge, going back to 2009, when they had 1.4 billion in debt. So they managed to get away from that, but they still got some long-term debt. It's only 191 million, which is very small in comparison to the size of the business. So essentially they've got it under control now. They could easily pay off that long-term debt with the net earnings that they're bringing in. But Persimmon have never needed to borrow. Now, debt's not necessarily a bad thing. If you can borrow at 5% and sell at 6%, then it's good debt. Debt isn't always a bad sign, but I like the fact that Persimmon have achieved what they've achieved, which is largely massively beating Barrett in pretty much every single tick box without needing to borrow any money. They've done it self-financed, which is great. That's a very good sign that the guys behind Persimmon know what they're doing. They know how to use the shareholders' money. The next thing I want to look at is the return on shareholder equity. So this is down here. Let me just get these up to the same level so it's a little bit easier to see. So over here on Persimmon, we're looking at the return on shareholder equity. What that's telling us is the percentage ratio of the net earnings that are coming in, so i.e. what's the money left, the profit left at the end of the year for shareholders, and how what the relationship is from that to the assets of the business. So in other words, when we look at return on shareholder equity, we're looking on, if you look at assets minus liabilities, that equals shareholder equity, essentially. So what is the return they're getting on the assets minus the liabilities? So in terms of if they're investing money into assets of the business, this could be property, plant, equipment, intangible assets, rights, patents, anything like that, trademarks, anything like that. Those assets, what return is this company getting on those assets, or what return are the shareholders getting off those assets? So for Persimmon, it's strong. It's very strong. We're looking at nearly 30% return on the assets that these guys have. That's really solid. Really, really good results. And they have been up there for a long time. Now, they went through a period after the recovery back in 2009. It took them a while to get up there, but they have been strong now for the last 5 years, consistently strong and growing. Notice this growth, 12 to 16 to 20 to 22 to 24 to 27. These guys have been growing really nicely. Now, Barrett are growing too. They've been doing things well as well, but they're nowhere near the size in terms of the return they're getting from the assets they've invested in. So all the money that they're pumping into the business and buying more assets, like I say, that could be property, plant, equipment. So we're talking about office spaces. We're looking at factory spaces. We're looking at equipment that they might need to do what they do. We're looking at plant, i.e. machinery. Could be diggers, and construction vehicles, that kind of stuff. It could be intangible assets such as rights, it could be patents, that sort of thing. What return So if you're investing in all these assets, you want a return from those assets. It's like buying shares. A share is an asset. When I'm buying shares for myself, I'm buying assets. They are assets that I own that are going to provide me with a passive income. Well, it's the same in business in so much that they're buying these assets, but they want to be getting a return from those assets. So what sort of return are they getting from them? Well, Barrett are not doing anywhere near as good a job as Persimmon in terms of buying assets and making them work for them, making them bring in income for them. So they're still doing okay. They're at 14.2%. It's not bad. It's just nowhere near as good as Persimmon's nearly almost 30%. So again, every single comparison that we're looking at here, Persimmon are looking like a stronger company, a better company. Another thing I'm interested in, and this is where things change slightly, is that we also tend to look, or I like to look at the retained earnings. Now essentially what this is this is a pot of money. So a company can invest money into property, plant, machinery, those sorts of assets. That's one thing they can do with their shareholder profits. Another thing they can do with shareholder profits is pay dividends, which we tend to see most of these companies doing, right? That attracts investors, it attracts more money coming into the business, great. It attracts more shares being picked up. And the other thing they can do with their money is they can put it into a pot. And that pot can be used for future investments, future acquisitions, mergers, whatever, buying out competitors, or whatever it might be. So Barrett obviously have a lot more revenue coming in, but they're making less profit than Persimmon. And so what we're seeing here is they're actually putting in pretty decent amounts of money into their retained earnings pot. They've got all the way up to 3.1 billion. They're literally sitting on 3.1 billion in a pot that they can dip into when they want to. Take a look at Persimmon, we're up to 2.6 billion. So essentially $500 million less. Now, they are making less revenue than Barrett Developments, but they are making more profit. So essentially, Persimmon are putting less money into retained earnings than Barrett Developments. So that would probably be a tick box with Barrett Developments being slightly better. In terms of, we can look at the percentage of growth that the company have been putting into this. Persimmon, we're looking at 64% over the last 6 years, whereas Barrett, we are looking at 72%. So yeah, Barrett have been putting in and growing their retained earnings that little bit quicker, but both are doing a sterling job. So both companies are doing really, really well with that. And I would say, even though Barrett have kind of tipped it a little bit, both companies get a tick box for that. They've done very, very well. And so that is essentially a crash course in what I've done to compare these two companies. Both companies are buying back their own shares from time to time. Barrett again are a bit more consistent with that, but that's no big deal. That's not a deal breaker. All that essentially means is that the other thing they can do with the shareholder money is they can start buying back their own shares. So they do a share buyback scheme that reduces the number of shares that are out there on the market and raises demand for the existing shares that are still out there, which therefore pushes the price up. So the more they buy back their own shares, the more kind of control they're getting back, and the less there are out there on the market, the less diluted the shares are, and that can generally be a good thing to do to raise share price. But essentially, this is the comparison that I've done between the two companies, and as you can see, obviously Barrett have tipped Persimmon on maybe one or two areas, but they are kind of fine-tuned areas where Persimmon has still done very, very well. The reason why I'm more of a buyer and I'm keener and actually a shareholder in Persimmon is because of all the other data, all the other stats that we've looked at here, where they're taking a much larger gross margin from the revenue. Even though they're making less as a business, they're taking a much bigger slice to the point where they've got a higher gross profit than Barrett Developments do. Even though Barrett are making an extra 1.1 billion in revenue, you look at the gross profit between these two companies and Persimmon are actually making more money than Barrett. Then we look at all the deductions that come out, the expenses and the costs involved in running the business, and Barrett have more expenses. It's costing them more to run their business. And as a result of that, Persimmon make even more money at the end of the whole process, at the bottom line. and so therefore their shareholders are making far more money. Plus they're doing better with their assets, making a much better return, a 30% return against a 14% return from Persimmon to Barrett. These are the reasons why I would be, and I am, a follower, a keen pursuer of Persimmon PLC rather than Barrett Developments. Now, like I said before, Barrett Developments aren't necessarily a terrible investment. They may do very, very well. But when comparing them against another company in the same market sector, this is the home construction sector, these are both companies within that same sector. And you really want to be putting your money in the company that have got the best possible chance of doing well. And for me, based on this fundamental and financial information, it's easily Persimmon who are the company. Now, share price has been going down on Persimmon. The share price for Persimmon is way higher than Barrett Developments. But recently we've seen a slump in the share price at Persimmon. But for me, that's a great opportunity to get in. Now, I don't necessarily like to buy into falling prices. That's not generally my style. But what I will be doing, and the way I trade and the way I invest, is that I look for buy signals. And those buy signals are mechanical. So I haven't abandoned. When I first did one of these videos, everyone was like, so you've abandoned your mechanical approach then? Absolutely not. I'm still 100% mechanical in so much that this is factual information. So I'm not predicting or making any, I'm not kind of, there's no wishy-washy approach here. I'm just using factual data, so it's a mechanical approach. And when I'm getting into any of these companies, I'm doing so only when there's a signal. There has to be a mechanical signal that tells me, right, here's a buy signal. The difference here that I have, I guess, evolved into over the last couple of years has been that previously I would trade any mechanical signal that came up. Now, any of you that have traded in that way over the years will have found that you're spoiled for choice. There's too much out there. You don't know how to pick between the 50 opportunities that sit in front of you when you're only looking for one or two trades to make. And you think to yourself, how do I pick between these 50 different companies that are all providing a signal today or this week? Well, this is how I do it. I will look at these companies and I will create a watch list of just the companies that have been performing financially very, very strongly. And those are the only signals I'm therefore interested in. So therefore I'm massively putting the odds further into my favour that the signals I do take have a better chance of doing well in comparison to just taking any signal that comes along from any company. And so that's my plan. So whilst Persimmon's share price has been dropping recently over the last, I think the last 6 months or so, this is an opportunity. And what I'm doing right now, I am a shareholder right now, so I've already got shares in this company I bought a long time ago. But I am now looking for a buy signal in Persimmon. I'm not looking for buy signals in Barrett Developments for this pure reason, because I don't need to have two positions in the housing construction sector. I only want one company in that sector, purely to diversify my risk slightly. Because if the housing sector takes a hit, then all I'm essentially doing is doubling that hit up if I've got two positions that are long in that sector. But also because Persimmon have a much better chance of going up based on the financial data. And I'm banking on the fact that the rest of the stock market will eventually see this, and I think they probably have, which is why Persimmon is trading at £29 a share and Barrett trades at about £6 a share. But yeah, I'm putting my eggs into the Persimmon basket, and this is all based on factual information. There's no prediction there, there's no gut feel or anything like that at all, no wishy-washy decision process. And yeah, that's what I'm doing. So I just thought I'd share that process with you guys so you can see what I'm doing, why I'm doing it, why and how I come to these decisions, and I'll allow you to obviously make your decision and decide what you want to do. And but I think it might give you an insight into what I'm up to. So thanks for watching. I hope it's been useful, and I'll see you guys very soon. Cheers.